The landscape now seems to be getting, I'd say, slightly better, but not to the point where we're prepared to start making more favorable changes within our credit policy.
All right, Ray, you ready to get going?
I am.
So welcome everybody. We've got we got quite a few people on this call, and I know that we're also streaming live on Facebook inside of our 7-figure house flipping and wholesaling group. It's got somewhere around like 5,000 people. So we got people watching from there. If you're watching on there, welcome. We'll also try to figure out how to get this replay out to some of you guys if you have to drop off or aren't joining or whatever that is. So obviously, we kind of went out to the 7-figure flipping community and everybody that follows us and said, do you guys want to do some Q&A with a hard money lender? And obviously, we have a great relationship with you at LendingHome, Ray, and what you guys do there with some of our mastermind groups and some of the lending programs that we've set up over the past few years. And so what I wanted to do is kind of Ray reached out to me and said, do you think that it would be valuable for the community to just ask some, answer some questions and do some things together? And I said, yeah, absolutely. We were going to do a podcast, but we figured this would be a better way. We can stream it live on Facebook. We can possibly kind of put it out on the podcast if needed. But really, instead of just me asking Ray the questions that I have, we can also ask the questions that you guys might have in your business real time. So what the structure of this call will take about like 30 minutes or so for Ray and I to just talk. I'll ask some of the questions that I have. Any questions that Ray's been getting over and over and over again by individuals, you guys know the best way for us to handle that is to get out to the world and talk about it so you guys can have it kind of straight from the horse's mouth. And then we'll take 30 minutes and I'll kind of queue up the questions that you guys have and I'll moderate this a little bit. So real quick, Ray, why don't you kind of introduce yourself for those of the people on the call who don't know you, maybe a quick, short snippet of who you are, and then I'll do the same, and then we'll just jump into it.
All right. Well, I appreciate you having me on. I've been at LendingHome just over 5.5 years. So spent the first 3 running all of operations internally, kind of building them up from a 50-person outfit to a rather large 150 million plus a month largest fix and flip lender in the space. Now, in my role as a director, I work with more experienced operators, trying to educate them on, the different opportunities of how to use institutional money to help scale their business. When you're working with successful people, they've already found money. Now it's just a way of being able to help them understand the construct of how a LendingHome or a lender like us can help them within their business, both from a process flow standpoint, saving standpoint, from a cost of funds standpoint, and then leverage. So, and then obviously technology, which is, I'm not going to say an ancillary benefit, but it has been a huge benefit how we've been set up from a technology standpoint going into this work from home environment.
Awesome. Well, I'm excited to jump in and kind of hear some of that stuff because we've heard kind of differing things from different lenders. A lot of our, let me give my background. I'll talk about like why we hear this stuff. So my name is Bill Allen. If you guys don't know who I am, I'm a wholesaler and flipper. I run a company called Blackjack Real Estate. We're in kind of the Southeast, Pensacola, Florida, Nashville, Tennessee, Chattanooga, Tennessee. We just went into kind of Huntsville, Alabama, and Bowling Green, Kentucky, kind of those states in the Southeast. And then I also own the 7-figure flipping Mastermind Group. So most of you guys know me from there. And if you don't know me, then that's kind of where I get a lot of my information from. So we're a network of flippers and wholesalers. That's pretty much all we do. And all around the country, anywhere from never done a deal to try to get their first deal to doing hundreds of deals a year. My company, Blackjack, we will probably do somewhere in the 160 to 170 range of deals this year. Mostly wholesale deals, about 80% wholesale, and then maybe like 20% fix and flip. So that's kind of my background. I use that network of people to kind of feel the pulse of what's going on. Obviously, like I said in the beginning, we have a great relationship with LendingHome. A lot of our clients inside the Mastermind Group use LendingHome to fund a lot of their deals. So I know that Ray and I kind of that Monday that a lot of you got an update of what's happening in the lending space when the stock market crashed by like 13% in an hour that morning. And you were getting emails and stuff. Ray and I had talked on Friday about what's potentially coming. And so we were notified of that. And a lot of our borrowers, like some of the people that are in my world, are the people that you're talking about that do some of the higher volume fix and flip loans. So that's kind of my world and my space. So I can answer some of those questions that you guys might have of like, how does this, like, what are you seeing? What's happening? And I know that a lot of you were probably on the webinar that I did 2 weeks ago, telling you kind of the state of my company and what I'm seeing. And I basically aggregate information from a lot of other people, wholesalers and flippers. So I kind of have the pulse around the country, thankfully enough, from the Mastermind Group. And it's kind of like my insurance policy too, that I see some of them in their markets. And everything is very local right now, it seems. So a lot of the stay-at-home orders are different from state to state, city to city, all that stuff. So I have some of that background if you guys have any of those questions. But why don't I'll just kind of throw it over to you, Ray. And why don't you maybe talk about some of like the, I don't know, state of the union kind of thing from LendingHome and some of the, like what you guys are seeing in the lending space, and then some of the questions that you've gotten, and I'll just kind of jump in as I need to.
Yeah, I think, everybody's world got rocked, including ours, on March 23rd, when I think there were lenders leading up to that were, correcting guidelines, changing guidelines, et cetera. And it was abrupt. It wasn't something that a 3 or 4 or 5 day period where we thought certain things were going to happen. It was over a weekend. We needed to make a decision because whole loan purchases in the fix and flip market shut off. And so what that means is anybody that was selling loans to a Wall Street company, from a fix and flip standpoint, they no longer had purchasers. It would be like nobody buying homes. I mean, and it was overnight. So, so what we're seeing is most of the companies that are still lending are in an environment where they had either set up, outside of U.S. funds, private money, or they fund loans into a securitization. But to give some people some perspective, I mean, the market leading up to that weekend, I think the market was very strong. There was very good credit quality. I think the one thing that I've tried to impress upon folks that I've been speaking with is this was not generated by like a credit breach, right? Which happened, back in 2002, 2006, 2007, where when they looked back, there was a lot of impropriety and poor credit decisioning and layering of risk, zero down, no money verification for income, very little reserves, et cetera. That isn't the case here. It was really driven by this pandemic and the effect of it, right? So people losing jobs and Wall Street really being in a position to ineffectively price loans correctly, right? So imagine you going into a home just going whatever, right, from a purchase price. And so you're not going to have a large variance of what you will accept. And so from a secondary marketing standpoint, these companies basically went from, paying, 1 or 2 or 3 points to lenders for their business in this pool of loans to accepting bids of, 85 cents on the dollar. 90 cents on the dollar. So you're originating the same good quality loan, and now you have to pay somebody to buy it versus them paying you to buy it. So that business model obviously is broken as soon as you say those words. So there were some, companies that thought that they could, I think, hunker down, scale back significantly, but at the end of the day, all you're doing is originating a loss leader. And so they had to a lot of lenders had to make the decision to temporarily stop doing business. Thankfully, outside of just the technology piece of LendingHome being able to, go to an immediate work from home environment, which people were doing already. And we had already built a very, I think, strong technology infrastructure for our borrowers and for our employees as well. That part was seamless. So there was no notice of difference as it relates to doing business with LendingHome. The biggest thing was we did not know the depth of the issue relative to the secondary market, right? So even though and this is public knowledge, so that's why I'm mentioning it, we sell loans into a pre-structured securitization. So it's like having a fixed rate line of credit. right? And it's relatively large because of our previous performance and quality based on the companies that have, issued those securitizations to us. But they're not limitless, right? And so if we need to go back into the market to structure another one or go into a whole loan environment, we needed to make the decision on that Monday, March 23rd of what does our new pool of business need to look like to preserve capital long enough to where we think this basically freeze of capital is going to last. And we didn't anticipate it to last, 30 days or so. We anticipated it to be 60, 90, 120 plus days. So we made a very, very abrupt decision. And I know several of your members felt that, right? Where they had an active loan and all of a sudden they were getting a non-favorable call from somebody at LendingHome. And that was not a good couple of days on either side of the phone. We have subsequently been able to adjust some prices, some leverage, et cetera, to some customers where it made them feel a little bit better, but not necessarily whole again. And one of the reasons why we cut so deeply is we did not want to nick and scrape our customers over an extended period of time, right? 1 week we dropped a little bit, then a little bit more, then a little bit more. It really would reek of you don't know your business and you don't know the industry that your business is in. So we cut deep and then I think improved a little bit. So, right, because April was that first origination month after kind of the crash, if you will, and then what will May look like. So my anticipation is that the market isn't going to be in a position to accept the lenders that are currently out of the space to come swiftly back into the market. I think it's going to be an extended period of time, and that's just from a fix and flip standpoint. From a rental standpoint, that market's completely evaporated. There's no rental business being done that isn't being done directly through either a bank, a credit union, or a direct lender like Quicken or Loan Depot. And that is because, the capital markets that were buying all of those loans, they cannot, with any degree of certainty, price those loans out correctly. And they're certainly not going to come out and say, well, we'll price a 30-year fixed rental loan at 13.3, right? They're not going to do that. So until they have an idea around the capital infrastructure, a better certainty around unemployment, that market is really going to continue to be dried up. And I would say that we probably, from an industry standpoint, will have maybe better visibility mid-May on how and when that rental program could come back. I think it will. I caution people that it will not, again, this is kind of Ray's opinion based on feedback that I understand from capital markets experts. It will not look anything like it did in March. Leverage, credit policy.
So I think just to give everybody some context here, if you're not in this, like if you weren't plugged into this and getting like loans changed or pulled or things like that throughout this time, basically what we saw inside of the Mastermind Group is we have 100% of the purchase price, 100% of the rehab at some sort of favorable rate, like a rate sheet, right? And then so on March 23rd, if that was the Monday, it was like the light switch like just went click and kind of went off. And kind of to like look back behind the curtain, it sounds like it was because just the people who were buying those loans. So everybody kind of should know how loans work. Typically, like you guys actually sell these, like package them and sell them to some Wall Street, a fund, something like that. And if they just stop buying, then you have no customer. And it's the same way that banks do business too. You've seen some of the banks raise their credit, the minimum credit scores, change guidelines, things like that, basically making it a little bit tougher to borrow money from them. So what we saw instead of go from 100% purchase and 100% of the rehab down to 80% of the purchase and 100% of the rehab. And then also slapping on some fees, like $4,000 in fees right out of the gate. And people had loans in process that were like, whoa, like I can't believe they're doing this to me. Like they're pulling the rug out from under me like a week from closing. Yep. And I was planning for this. They had to go raise money. So what we did inside the Mastermind Group was we just like jumped in and said, okay, let me teach you how to raise private money in 3 days. let's go figure out how to raise that 20% so you don't have to worry about it. And so we kind of had to go to work, and then you and I talked, and it wasn't only a few days before we got some more favorable terms. So I guess for my question is, what does that do? Like that 20% of the purchase price chop, is that because you guys, like in my mind, we have more skin in the game, but it seems like you would still be selling those loans. So maybe the people that are buying the loans, you just need to make a bigger spread off of that in order to sell it for the price that they're buying it for. So there was still some appetite to buy that on the secondary market. It just wasn't as favorable terms for you guys.
Yeah, so that's a good question. So we're still not selling loans into the secondary market. We are funding them into the securitization that we created. So that's still taking place. The anticipation, though, is these loans that are currently in the securitization will pay off in 4, 6, 7, 8 months, right? So they're going to sort of outgrow the current securitizations that we've already structured. And so the mindfulness that we have is when we restructure and sort of re-sign up for the next securitization, what will that loan profile need to look like for us to get the most favorable terms, right? So if it was just simply what fits in the existing securitization, then we wouldn't have had to make any changes. But we also have to preserve our capital, because even though our cost was somewhat fixed in the securitization, the capacity was not, or was also, right? And so if your volume outpaces your payoffs, which you would hope they would, right? If that means you're growing, then you would basically outgrow the size of that particular securitization, right? Which was, I think we had built, I think, a couple at 100 million apiece. And so that's what what we're also planning on, if we have to go to an alternative source of funding, right, back to whole loan sales, what appetite would people have, and what would the loan profile need to look like from us to them, so that we could get more favorable terms, right, and at least keep our business profitable. And so those were all of the, when you don't know what somebody's going to, from a cost standpoint, you have to guess. And so when you said, we slapped, good word, I'll use that, the $4,000 fee on and the rates, et cetera, then all of a sudden we had 3 or 4 days to really kind of have that season and simmer, and went, okay, we probably went a bit deep and a bit punitive, so we can peel that back. And we did rather quickly. I mean, within 3 days, it felt like 3 weeks, right? All of what was going on. But we still don't know what that cost will be and what that requirement will be in the future of when whole loan sales actually opens up. Because what you have to look at is those Wall Street companies, instead of investing in fix and flip loans, which inherently have more risk than a consumer mortgage loan, they're going to go be able to get a good quality loan that they can go buy for 70 or 85 cents on the dollar with the same quality. Why would they go pay 102 and 103 for good quality when they can go and get it at 75 cents, 80 cents, 85 cents on the dollar? So that's kind of the first direction those Wall Street companies are going to go. That will dry up, right? Because it's not an infinite amount of loans that are going to be sort of adversely affected like that. Then they'll turn to, okay, let's reinvest in this market, this fix and flip market, and where will we pay? What does that credit profile and borrower profile need to look like?
Yeah, so I think that makes a lot of sense, because if I think this is helpful for me, at least. So hopefully it's helpful for everybody on the call in understanding like what has to happen behind the scenes. Like, you guys are running a business as well. So what you're doing is you're having to anticipate the future market and what that's going to bear. And so you're de-risking what you guys are doing on the front end, because you're going to have to turn around and in the future kind of figure it out. All the wholesalers on the call, we know exactly what that's like. Like right now, we're trying to figure out what the flipper will pay before we go in the house. And it's a little bit uncertain right now. So what are we doing? We're trying to buy a little bit deeper in anticipation that buyer is not going to pay as much as they would, 2 weeks ago or 3 weeks ago or a month ago. So it makes a lot of sense to me. So hopefully that's helpful for you guys that are listening, because if you understand their business model, then it's not as painful maybe when you hear it and you start understanding how it works and getting it, and then deciding, is this work for me? Because it's interesting, because one of our mastermind members, I'll give him a shout out, is Glenn. He basically said, no problem. Like I just have to buy $4,000 cheaper on the purchase price. So I'll just go in and offer $5,000 less and renegotiate that. So I'm building this into my numbers. Like if I know that I have to pay this $4,000 fee, then I'm going to go in and I'm just going to renegotiate. He's like, it was an epiphany that I had of this is just going to force me to be better at buying. So he kind of changed the way that he was thinking. Instead of like throwing rocks, he said, okay, well, how can I fix it? And I think that's what a lot of us are going through right now. So, okay. And what other kind of questions are you getting right now before I kind of jump into some of these questions that they may have? I have a couple more too.
When do we, I mean, in a general sense, obviously, when do we think that this thing's going to, when is it going to be like business as usual kind of a thing? When do we think we anticipate this is going to be a potentially 60, 90, 120 day run as it relates to capital markets being frozen, right? That doesn't mean that we think that after 120 days, it will be back to normal. It will take 18 months to get somewhat back to like what it felt like in March, right? As it relates to trajectory of business, confidence in the capital markets that delinquencies did not spike, right? So every lender is looking at really two things. One is what are the payments each and every month? You have basically one opportunity each month. Are people paying us? And then payoffs. As people finish projects and sell homes, is our run rate the same as it relates to those projects paying off? And so, the good news is April was a very good month as it relates to projections, right? So what we thought would happen was better. So that's good. So we were a bit conservative on that. I think May and June will be good tests for us. So I don't have any anticipation on that because you can't guess. We speculated, which is how we came at our, leverage cost and rate decisions. I think one thing that a lot of people ask is from a valuation standpoint, you're a lender. Are you guys just like, looking at a valuation of a property? Because we still do not require for experienced qualified borrowers, an appraisal prior to closing. So we're still using that scope of work. We're still using the data from the market. So if the data in the market says that, a home with those renovations, is a range is like 310 to 330, but more of the value is closer to 310 to 315, we're probably going to come in at 310, 315. But what we're not doing is saying the range is 310 to 330. We're going to cut 310 by 5 to 10%, and we're going to come in at 270. Like we're not doing that. So if the market data supports wherever it supports, that's where we're coming in, because we don't anticipate a pop in value, right? Just a complete burst of that for a couple of reasons. The main one is there was low inventory going into this pandemic. Now there's significantly lower inventory. The first-time home buyer market got better. I think the market that we're probably looking at more closely is the move-up buyer market. So depending upon where that is regionally, and what we are also looking at is what are the consumer mortgage lenders doing relative to their credit policies, right? So for the most part, they haven't changed from a consumer standpoint. VA and FHA, and for some reason, increased their FICO thresholds, which threw me for a loop, why they would do that. So because I don't necessarily think that how somebody has paid over the last 16 to 18 months has anything to do with whether or not they are going to keep their job, right?
You feel like that's a little bit of that is just to try to like take on less borrowers and like underwrite less loans.
They're doing exactly what we did, which is they're anticipating what, when they pull loans into sort of a bond, right? They at least want that thing to at least be, par or better, as opposed to, funding all of these loans and then basically having to take a loss leader on, $150 billion worth of loans. So that's the reason, but it's just one of those things that, like our $4,000 thing didn't make sense. That FICO increase in the moment doesn't make sense. Will they soften that? I don't know. We softened ours because, lack of a better phrase, we came to our senses, right? And so through evaluation and accounting help and finance help, et cetera. So
So one question that I have here is you guys went down from 100 to 80%, and then you went, you kind of, after a couple of days, that changed a little bit. So where did you guys land? What's it like now for somebody maybe who, maybe from the different programs? You guys increased your credit limit a little bit, credit score. You guys changed the leverage, and then did you change fees? And then where do they sit now?
And so specifically for what borrower cohort?
Let's go to the experienced person first, and then I have another question here that would kind of, somebody asked, do you guys do loans to somebody who's never flipped a house before? So let's go to the experienced borrower first. What does that look like? And then maybe like in the mastermind and out of the mastermind, if that helps.
So our minimum FICO score is 660 across the board now. It was 620. So we increased that to 660 again, because the anticipation of people needing alternative sources for capital. We felt that when we looked at our book of business, that made a significant difference relative to default, right? And so we were able to kind of skim the potential ones that may default in that 620 to 660 cohort. So we felt that our book of business improved. Right now, to experienced folks that have flipped 5 or more properties in the last 24 months, we're lending at 80% of acquisition, 100% of rehab. If they're a member of 7 figures, that's 90% of acquisition and 100% of rehab. And then we are a very FICO driven now scoring model relative to in this environment. So 660 or better is going to have one range of price, and then 720 or better is going to have a slightly improved, probably by 50 basis points. If an operator already had an origination point structure, we've kept that. So we did not change that at all. And then the loan fee or junk fee or servicing fee, whatever word the folks like to use, it's $999. So it's $1,000. And so that is going forward in the foreseeable future, how that is structured. So how people should look at it as is, regardless of experience, we're going to require 20% down, right? So whether they've flipped 0 properties or, to your point earlier, 100, we're requiring 20% down. So if they're 5 or more flips in the last 24 months and they happen to be a 7-figure member, then they're at 10% down versus 20% down. That's kind of the cuts that we've made relative to our programs.
Okay, and that $4,000 fee came back to $1,000 for everybody.
Yep.
Okay. All right, cool. And then so somebody asked,
everybody who has 5 or more flips. If they have less than 5 flips, it's $2,000.
Okay, 2,000 with less than 5. So I think that answered. Somebody asked, is having flipped a house a requirement for LendingHome to get a loan? And the answer is no.
Nope, just FICO, basically.
Okay, awesome. Let's see. The next one is Eric had a question saying the biggest. Let's see, when stated loans and refinances will come back, or what will be the alternative for BRRRR or safety nets on flips? Let me see if I understand that question. Maybe you might need to rewrite that one, Eric. If and when stated loans and refinances come back. So do you guys don't do
that is because it's tagged with the BRRRR. The rental program that we had did not require income documentation, and it did not require any type of reserves. We went up to an 80 loan to value. I anticipate when the rental program returns, which it will, and it will, my opinion, at least during the summer. Could be as early as late May, could be in June or July, but it will return. We still will not require income documentation. The reserve piece, I think, is the one that will change. There'll either be a reserve requirement, or there'll be an interest payment escrow requirement, meaning either LendingHome or some facility will have to house 3 months or 4 months or 6 months. I'm making up the numbers, but from a concept standpoint, I believe that the quicker that program comes back, that element has to be a piece for the investors that are buying loans from lenders, right? Because they're knowingly lending money to someone that might have a tenant lose their job, right? So does that person have sort of the the financial stamina to withstand that. And their definition of financial stamina might be 3 months or 6 months worth of payments escrowed somewhere, right, with the lender or somewhere. It'll probably be with the lender. That would be my guesstimate. And then leverage probably won't come out the gate being as high as it was. So if you had some lenders that were maybe doing 80% cash out, that might be peeled back to 75 or 70. Again, initially. So I think the program will come out in bits and pieces. I think bad change always happens abruptly, and then good corrections always happen slowly. And that's, I think, what we're going to see.
Yeah, and if anybody's in the commercial space on this call, you saw that even happen with like Fannie Mae. They're requiring heavy reserves on larger commercial buildings, like 6 months plus in reserves on top of what they were already requiring. I mean, we're doing a deal right now for $12 million, and it added another nearly $1 million to our raise of capital that we had to come up with. So it was painful. So. Let's see. Daniel asked, and I don't know if you can answer this. He said, what funds are buying loans now? So I don't know if it's something that you can even share with us.
I mean, unless somebody, I mean, there's a lot of local, regional hard money lenders that are still operational. So they've either raised funds or have private money, et cetera. But if you were a lender in the US and you were selling whole loans, nobody's buying them. Like, nobody is buying them. So that's why there's fewer lenders. And so certainly the feedback that I've gotten from borrowers that use private money, right? So I would say maybe 20 to 30% of those private investors actually pulled away, either pulled out or pulled significantly away, but then 60 to 70% of them not only are still providing your operators good capital, they actually even went more in, right? It's just like, wow, this is real estate. This is an opportunity. I see it as a good opportunity. So it's certainly not all funding sources dried up. So to your point, when you said, hey, let's go raise funds, here's a 3-day, kind of lunch and learn, if you will, on how to go do that. There's absolutely people that want to invest in a tangible asset like real estate, and especially residential real estate in an environment like this. Just not everybody, but for the most part, most people are. So again, unless you're getting your money outside of the US or through our securitization and you're a larger institutional lender, you are not lending money. Okay.
Yep. Let's see. There's a couple other, he said the same guy, Daniel said, they were selling at close to 95 cents on the dollar before. And I think you mentioned 85 cents on the dollar or something like that in the beginning. Maybe Daniel missed it. One of the first position with no seasoning selling for. So, yeah. Okay. Let's see. A couple questions on that. The number of flips, like how to get to 5. So defining 5 flips. Jaime said, do we show that we bought the house and then sold the house? What about if it hasn't sold yet? Will a JV count as one of your flips? So how do you guys define those 5? And then another one of our members asked, do rentals count, or what does that look like?
Yep. So this is where I would say, get your pen and pencil out. So one of the, I think, frustrating things I feel if I was a borrower is just the lack of standardization that hard money lenders have as it relates to how they calculate experience, right? I think it's a bummer. So there's certainly opportunity if a lender does it a little bit more favorably. I'm not going to say that we do it more favorably or less favorably, but so what we look at is very simple. Last 24 months, and from like today's date, we look back. The property had to have sold in the last 24 months. So the sale date after you acquired the property had to have been in the last 24 months. Second, the exit price that you resold the property for has to be greater than $50,000. Third, the operator or the entity had to have taken title to the property and held title greater than 30 days. And then from the acquisition date to the resale date, that time frame has to be 36 months or less. That's all of the qualifications. I can certainly get into the how sausage is made, why we do that, probably unnecessary for like the general folks, but that is what we look at from an underwriting perspective to either count or not count. So a rental refinance would not count because the property wasn't sold. If somebody went in on a JV arrangement, more than likely they provided the money or the sweat equity, but their buddy right, took title, their buddy is the one that basically in LendingHome's eyes flipped that property. So unfortunately, that sort of cocktail napkin JV arrangement, it won't help them as it relates to experience with LendingHome.
Unless they're the buddy that took title.
Unless they're the buddy that took title.
And then, so you also got obviously that kills a lot of the double closings that wholesalers do, like hold it for 2 days, the 30 days. So just, it's pretty obvious. Like, are you buying houses, fixing them up? And even like wholesale seem to fit there. You buy it, you put it on the MLS, you own it for 45 days and it's done. So, cool. Let's see. Somebody asked, are you lending in Indiana yet? So I'm assuming the answer is no, and you're probably not. I know the last time we talked, it's like, hey, when are you going to expand into my state? We're looking at doing that. This doesn't really seem like the time where you guys are going to be looking for business development in new states. But
no. There are 8 states that we're actually pursuing in 2020. Indiana is one of them. Wisconsin is one of them. Just spoke to our buddy Jeremiah. Kansas is one of them. So we had a nice conversation this morning. So finally had some good news for him. There are obviously 5 others. I'm not sure which ones they are. Those are the ones that have been asked for like the most from like large groups of people. But the other 5 I can't speak to. But I know off the top of my head, I knew those were 3.
And I figured we get the question of like, what states do you guys lend in? Is the best way for them to find that to go to LendingHome's website and see all the states?
I believe they can find it there. We're in 26 states.
Okay. And yeah, we're not going to list them all here. So if that's your question, there's a couple questions in here that are asking that. Yep. So you can go to their website. It's just lendinghome.com.
Yeah.
Okay. And check that out. Jefferson said he joined late. Is there any interest reserve needed up front for members of 7-figure flipping? If yes, how many months?
We don't have a reserve requirement at all, or a liquidity requirement at all from a lending standpoint. So the 2, like somebody said, hoops. I like that term. The 2 hoops people have to jump through are flipping experience and FICO. And then obviously we'll review corporate documents, but those are the only 2 hoops. The only time that we really get into a liquidity or a reserve question or verification is we approve folks at $2 million of funding capacity. So if they want to go above that, that's when the liquidity would have to come out. And usually in most of the states like Midwest, East Coast, people are going through property so quickly, $2 million is not that big of a deal. When it has been, then reserves have been verified and funding capacity has been increased.
Awesome. Another question, no formal appraisal like process with LendingHome. What about fees, those kind of things? If you can just go to the appraisal portion of a loan.
Yeah. So the junk fees that I mentioned, $1,000 and $2,000, those are inclusive of either the pre-funding or the post-funding appraisal. And so if you're at 5+ flips, we do not have a pre-funding appraisal need. We get that after we fund. So that way, we use our technology to help accelerate the closing. All right. So we're not having to facilitate an inspection and waiting for an appraisal report for operators that are more experienced. And so whereas the lesser experienced operators definitely have that either a hybrid appraisal, BPO, whatever you want to call it, but we need that prior to closing. And in this environment, that could be 5 to 7 to 10 days to 10 to 12 to 15 days. So usually if you have 5 or less flips, I would account for 30 days from I've got this contract, when can I close? Whereas if you're 5+ flips and you're already approved, I would say, depending upon how fast we can get title, it could be as fast as 7, 6, or even 5 days.
Awesome. Yeah, we funded some loans really fast. So that speed is not necessarily changed in this environment that you've seen.
Nope.
Okay. I got a couple on like FICO scores. Let me just run through them really quick. So I got a business, 2 people on the LLC. One of them has a really good FICO score. One of them doesn't. So one person's got an 800, one's got 640. How do you handle that? And then just to follow on with that, multi-member LLC, where each member has done flips in like separate entities before. Are you pulling that into this entity as experience?
Yeah. So I'll answer the first one. So as long as in the multi-member entities, as long as an entity member is at least a 25% member, that person can be the guarantor. The guarantor's FICO is the only one we pull. So the suggestion would be if that 800 FICO person's at least 25% member, that person, that's an obvious no-brainer. They're going to get the benefit of meeting our 660 threshold, and then B, the benefit of the 720 plus pricing. And then secondly, on your question, if you had multi-members and they have flipping history prior to the entity that they just structured, yes, every single one of those members, we will pull their experience from the last 24 months toward credit. So yes.
Okay. What about debt to income ratio and tax returns? Do you guys look at that stuff?
No.
Okay.
We don't require any tax returns. The only time I've ever asked for a tax document is when nobody could prove like ownership percentage, and like they gave me a K1 to go, hey, I own 50% or 100%, but we didn't use it for income, right? So we're not asking for 1040s or 1120s or anything like that. Thus, there's no debt to income ratio.
Yeah. Why would you, if you have a partnership, why would you have an operating agreement or to show? I mean, you don't need that, right? Okay. What's your longest loan term for flipping?
24 months. So we have a 12, an 18, and a 24 month. The 18 and 24 months are 50 basis points higher in rate than the 12 month. And so what I've seen in the last probably 30 days, actually 2 weeks probably, is people going into 18 to 24 month where they genuinely have a rental program or property, and they're using that 18 or 24 month term to bridge the gap to when they feel the rental market will get back. Right. So they don't want to force themselves to, oh my gosh, I have to make a decision to either extend at a cost or refinance again into another, loan like this. I might as well just make the decision because there's no prepayment penalty on the 12, 18 or 24 months. So if things return back quicker than normal, yeah, you paid 50 basis points extra on a, hopefully lower loan amount, $160,000 loan for a period of time. And now you get to refinance into a rental loan. So,
is that an assumption that you're making that they're doing that with a rental for 2 years, or are they telling you that they're doing it as a rental?
They're telling us that.
And that's okay. You guys don't have a problem with that.
Yeah.
Okay. You just know that they have to pay you in 2 years.
Yeah. I mean, at some point they have to have an exit, right? It's either going to be sale, but at least from a strategic standpoint, it buys them more time. And more than likely in this market, if they're forced to sell, let's say the rental market doesn't come back, more than likely their equity in that property went up.
Yeah. You mentioned something earlier when we're talking a little bit about kind of doom and gloom on the lending side. And I think a lot of that is tied to the Wall Street world, like the stock market and things. What I see is you mentioned the fact that we were at a very low inventory going into this. And I know if you guys weren't on the webinar that I did 2 weeks ago, or haven't listened to the podcast, the 7-Figure Flipping podcast or anything, and some of the other like Facebook lives that I've been doing, is what I've seen, when we look at our numbers inside of most of our cities and states that we're flipping in, for every one house that's going pending, it's like a half that's going back on the market. So like our inventory is going way down now, and our houses are fixed up. They're really nice. They're also vacant and easy to show. And so they're really moving. Like most of our mastermind members right now, okay, you're listening to this on April 23rd, is their stuff is moving for at or above asking price and really, really fast, even in states that are pretty much shut down. So it's really amazing to see that. And now keep in mind, a lot of these people are in that first time home buyer. This is not luxury. This isn't multi-million-dollar homes. And that's really my advice, is that's where you should be flipping anyway, unless that's what you do and you do 10 like multi-million-dollar houses per year. But it's really good sign right now of what we see. Like you mentioned, like we hope they keep making their payments. We've paid off almost all of our loans recently. We actually have so much money right now that we paid off another one because I didn't want to pay for any extension or fees or any of that stuff. So what I've seen is a lot of those houses are moving. So I don't want this to be kind of like doom and gloom, because it's more of that. Like the context that you should be hearing this is more from the secondary market buying these, like, and just being a little bit uncertain about what's going to happen and waiting it out a little bit and kind of using more break. Whereas, I mean, I'm a little bit bullish right now for what I want to do. We are being cautious. And that kind of takes me into this next question, which is, how are you guys adjusting your ARVs? Are you doing anything standard, like dropping by a certain percentage of what you're expecting? I know you guys are doing kind of like tabletop evaluations first. Are you guys actually putting in some sort of reduction at all, or an expectation on that?
Yeah, so I tried to mention that a little bit earlier. I mean, there is no embedded cushion that we're using. We are, like I said, if we had the luxury of seeing a variance in value, but the predominant values are closer to the lower end, we're probably going to be conservative on the lower end. But there is no pad where we see that the variance is, between 3 and 350. And then we're going to go, not only we're going to start at 3 and then reduce from there. That is not something that we're doing. So we're still using the market data that's there until it tells us that it's not. And so to your point earlier, I mean, we are seeing in almost every region multiple offers, especially in the first-time home buyer market. But again, that first-time home buyer market is relative to the region, right? And so, but here, even in California, I mean, there's certainly a slow down from an inventory standpoint, but when things are going to market and they're, in that certain price range, they're gone. So,
yeah. And so it's Matt Kimball is one of our members in Seattle. So I think arguably Seattle is one of the hardest hit cities next to New York and California and some of these different areas. But he said we just got an asking price offer on his flip in 4 days. So really awesome to hear that. So good job, Matt. And I know he's asking a lot of the questions of like, man, I'm so close to that 5. I really want to get this better term. So another question, can you briefly explain the rehab draw process that you guys use?
The rehab draw process it's a construction draw process. So it's basically reimbursement for work done. So I'll use numbers. So if you have a $25,000 rehab, you need to start the work. When you want to draw, whether it's halfway through or at the end, it's an easy email to our construction team. They'll arrange for a local inspector to go out to the property. They use the operator scope of work, and they validate the either work done or percentage of work done, and then we wire those funds into the operator's account. What I typically see, and there's a $179 cost for that inspection, but we do not dictate the number of inspections that need to be done per project. So if somebody can actually stomach a $25,000, $30,000, or $40,000 rehab and just get one draw at the end, so they want their money back prior to listing, I see that a lot. If somebody needs to break a $30,000 project into thirds, we will do that as well. So that's the process that we do. So we're trying to avoid having the receipts and invoices and I can't get out to the property. Maybe you're doing, maybe you're flipping remotely, right? Like you do. And so can't necessarily go let somebody in or whatever, or you be there to take the pictures to send to us virtually. And so we feel that this process is very similar to how most institutional lenders do it, how most banks do it. Is it like how your dentist, the dentist at the donut shop does it? No, they front all the rehab money. They don't want to deal with administrative rehab draw processes, et cetera. But that's how we do ours.
Yeah, I've in my experience, it's been very painless. We submit the information, the inspector goes out there, checks it off, and the money comes that same day or next day. It's very, very fast.
If they've missed something, we have the ability to either on the spot correct it, right? Because we can see that it's done, and maybe they missed it, right? And so they went through their picture took full credit of it, but they didn't. But for some reason, they just missed on the percentage. The other thing I get asked on the construction process is, let's say, do we pay for partial money on a line item, for example, rough plumbing, right? So you're not going to complete the plumbing, obviously, until the end, but most of the plumbing line item is probably in the rough stage, right? So that's 80% of it. Will we pay, 80% of that? And the answer is yes. And so as opposed to waiting for a line item to be 100% done before we pay it. So we pay it as it's progressed, as opposed to waiting until, in a linear fashion, if you will.
Yeah, what I've noticed is the better I have my paperwork in order and my submission and my request and all that stuff, it's in order. You get the inspector in, the money just comes right away. So it's not and if you can get some like net 30 terms or some better terms with a lot of your vendors, then you don't even see a lot of out-of-pocket expenses. So we have some techniques that we talk through in the Mastermind Group about how to take a benefit from this and not feel like you're having to come up with all the money, like, $10,000, $20,000 at a time to figure out how to do that. So there's a lot of different techniques and behind the scenes stuff for us as flippers and that we can use. So another question is, are non-recourse loans still available, or are they all PG now?
It's usually a personal choice. There's a cost to, if you're at the 5 flip level and above, you have the option of not personally guaranteeing the loan. There's a 100 basis point increase to rate to do that, whereas that option does not exist below 5 flips. What I try to educate people, since we're recording, I'll save that education for people individually, but We've closed over 21,000 loans. I think we've roughly went to foreclosure on maybe 140, 150. We've always been able to have the property solve the issue, right? So we've never had to engage the personal guarantee portion because the property has been able to resolve paying us in 21,000 loans. So if somebody, the only time I really see it is when you have a multi-member entity and somebody's like, I'm not taking on everything for everybody here, right? That's when it's more typical. Like the single member entity I scratch my head going, this kind of doesn't make sense based on the stats that I just gave you.
Yeah. Let's see, to lend on a property, is it where the property is or where the investor is? So where the person lives?
Yeah. Okay. So somebody can live in Indiana, do business in Ohio, and we're cool with that. They can't do the opposite.
Awesome. While we're here, there's a bunch of people watching we're live on Facebook in the 7-Figure House Flipping and Wholesaling group. So I'm monitoring that too. So if you guys have questions that you're on there, you can just put them in the comments there on Facebook and I'll make sure that we get those answered too. And the other thing that I want to say is if I'm skipping your questions and we're not answering them, it's because we already answered them and you may have come on a little bit late to the call. So I'm just going to ask that you go back and listen. We'll send out the recording to those of you that have registered or are on it. So I just ask that you go back and listen to it or see it in the Facebook group, just because I'm not going to ask Ray to answer the same questions over and over again. Here's one, and you and I have not talked about this actually. Do you anticipate going back to 100% funding for the Mastermind Group?
I anticipate it. Don't have a date, but I think like everything, we were able to get there for a number of reasons, right? The market was acceptable to it. Our performance, your group, et cetera, was acceptable to it. I think the same thing will continue to take place, going forward. So, we are looking to get back to more of a business as usual. And so, and that is having a truly defined credit policy that also allows for some strategic flexibility based on performance, right? And based on sort of logical data, as opposed to that person's a good guy. What we're not going to do is go back to the kind of the grading scales back. I used to work for a subprime company, and even before that, how could a Wall Street company, when something was considered A paper or B paper or C paper, the performance varied, the underwriting varied. We have to have a consistency around that. So when we reach that, we absolutely plan to get back to that at some point.
Yeah, and the person that asked this, I can tell you that I will be on Ray's tail the whole time, pushing him to figure out how to do it as fast as possible. So.
That line is so long, so they're going to have to cut.
Yeah. Okay. So here's another one. Are LendingHome's loans still considered a cash at sale appointed transaction? If not, I might have to change my contract. I don't necessarily know that that's a question for Ray. That's more of a question for like the title company, whoever you're running your contract through. For us, we treat it as cash. A hard money loan is cash. It's not the difference for us when we put it on the contract is, are we making it contingent on financing? Basically, at least it's state by state. Every contract is a little bit different. Every title company, you may have to do an addendum saying that you're going to bring in a loan, but they can close faster than most, like any small bank, private bank, even private money lenders. A lot of times I can get it done with there are some documents that have to be signed to go through the title company and things like that. So just talk to your title company, bring it up, but we'll submit a CAT. In Florida, I can submit one that says cash. All it does is say that I'm waiving my financing contingency, so they can keep my END if I don't get financing. Yeah. So
we will not make the contract be changed because we're financing something on a purchase agreement that says cash. We won't. That's irrelevant.
Yeah. So on their side, they don't care. The only time that I've seen it become an issue is if the title company or the seller makes it an issue. Matt, I think the answer is no. If we're local to our property, can we do a video walkthrough and cut out the inspector? I'm sure they want to see their inspector go. Right?
Yeah. I mean, it's in our It's in our charter and our covenants that the reason why we have to be the one ordering the appraisal, whether it's post-funding or pre-funding, we say that we will. That's what we commit to doing within our credit policy. Similarly, in the credit policy, does that mean that we'll forever do that? We're always working on ways of being able to make that process better, faster, smoother. But currently, as it stands, we have to own that process.
Awesome. There's one here about multi-member LLCs. So we talked about it with like credit and things like that. What if one of them has experience and the other one has the credit? Can they like share like that, or does one member have to have the experience and the credit?
Yeah, I mean, like I said, if you have two members of an entity, and as long as 25% is that point of sort of demarcation, right? So if you are at least a 25% member of an entity, then you have the ability to be the personal guarantor. So if that's the person who has the credit, but the other person, has the experience. Maybe that's the reason why they're, pulling themselves together anyway. So as long as the entity is structured that way, what can't happen is, let's say the experienced person doesn't meet our credit policy, right? And then they add the 800 FICO to the entity. We would wait 6 months before we could allow that addition, or that corporate resolution, if you will, to take place as it relates to what we would allow. But if somebody went out and formed a new entity today, then we would use the guarantor's FICO, whoever that member is, as long as they're 25% or greater, and then all of the flipping experience for both of those members over that 24-month period of time. That
makes sense. Yeah, not just adding a shell person on there with a credit score.
I know it probably is, it might be a shell game, but I'm defining how we can do it, and then I'm defining how we can't do it. So hopefully that was enough of a definition of how we can.
Yeah. What about lending to an IRA or 401k? So can they flip in their IRA and 401k and get loans from you guys?
I think that the main answer to that is, if the IRA is a member of the entity, the answer is no.
Okay. So if it's buying in the IRA,
they're using IRA money, that's okay, because we don't source where money is coming from a down payment. It just has to come from the borrower, obviously, through escrow, but we're not going to source the funds and ask them for explanations for that. But if the IRA is the member, there are stipulations within those requirements that we can't lend to.
Okay.
I know some lenders that are still available, and I can tell them where to go if they need to, but it's not with us.
Yeah, I have a question on that I'm saving for a second here. So somebody asked about the Mastermind Group. Says we keep mentioning it. What is it all about? Can you tell me more about it? So I'll real quick. Like the whole purpose of this was to come on and give you guys information, not necessarily sell anything. So I certainly want to be cognizant of that. But we have two Mastermind Groups. So we have the 7-Figure Runway Group, which is open every October at an event that we have called Flip Hacking Live, and our members are 6 months in. So these are the people who have done less than 10 deals per year, less than about $200,000 in kind of gross profit, and just getting going, like have never done a deal or have only done a couple, kind of what Ray's talking about. They're kind of the borrowers that are under those 5 flips. Maybe they've done 6 or 7 flips, or maybe they're doing them. They're just not consistently doing deals, and they need that foundation. So we opened that group up in October. We'll open it up again at our event called Flip Hacking Live at October 15th through the 17th in Orlando. It's a live event, 3-day live event. Fantastic for anybody who hasn't been. Ray was there last year. LendingHome was a fantastic sponsor of the event last year, and I'm sure we'll do that same thing again. And then we also have the 7-Figure Altitude Group, which is open all the time for the more experienced people. So, and you can check that stuff out on 7figureflipping.com. So we have just rolled out kind of a video series recently on just some different videos that we've used inside the Runway and Altitude groups that now you can kind of check out on 7figureflipping.com. So go there, check it out. You can talk to somebody, put in some information if that's something you're interested in. Let's see. Eddie said, Eddie, no, your account is still active. He said, I've done some deals with you. I did a deal with you guys in the past, or I haven't done a deal with LendingHome in a few months since you guys changed your terms, but do I have to re-sign up for anything, or is my account still active? Like my line of credit still active?
Yeah, the approvals are good for 12 months. We re-pull a FICO every 6. So if he's approved in the last 12 months, he should be still good to go. But obviously the terms that he probably has on his term sheet from when he was approved no longer apply. They're going to go to what they were on March 23rd. But from the approval standpoint, he doesn't have to requalify from a flipping standpoint or anything else.
So what's the process then to figure out what those new terms are since March 23rd? Just email somebody at LendingHome. What's the plan?
If they're already working with somebody, just reach out to the salesperson that helped them kind of get approved. Just go, hey, can you give me a call and walk through process flow, terms, et cetera. Maybe they're in a market that we can be more favorable in, like California. We don't have any market that we ding, lack of a better word, but California is just a more favorable market from a lending standpoint. So we pass along some of those rate savings to some folks. But yeah, that's the first thing that I would do is and certainly if they don't have or can't find their contact person, I will answer the question right for them. That's not a problem. And then I will direct appropriately.
Great. And at the end, we'll share some of your contact information for them so they can get a hold of you if you're okay with that.
Yeah.
Imran said, has a good comment here that I just want to share with everybody. He said he went through this as a wholesaler and flipper in 2008 and 9, just kind of like, obviously a shift and change. Like we're seeing, it's just a change. It's something different right now. What happened is a new group of all cash buyers came out of hibernation and replaced some of the leverage buyers. So he said those cash buyers are out there waiting for a market like this. So sell some contracts to them. So if you're a wholesaler on the call, I think that's really interesting because when I read that, where it took me to was as wholesalers now, we're starting to see some of the people who need the leverage and the leverage change. So there could be either exiting or rerunning their numbers where those end cash buyers are out there. And we may have kind of gotten soft on our disposition side, our buyers list, things like that. So these are new cash buyers. So if you're constantly networking and getting out there and watching who's buying in the neighborhood still right now and could be using all cash, these could be people that might not be on your list that you need to keep your eye out and keep the radar going. If they're coming out of hibernation now because other people can't get money, it's probably because they don't want to pay the prices that the other people were paying before. So they might be paying less, but it's something from a tactical side. And this is like, I'm all data. I'm all numbers. You mentioned a ton of data like you guys are I'm just looking every single week. What are our numbers look like? What's happening? What's the feedback that we're getting? It's supply and demand, just like you guys have. You guys are like the wholesaler in the lending marketplace, and we're the wholesalers in the house marketplace. So I'm really trying to just feel the pulse of what's going on. Like you said, you guys cut pretty deep and then went, whoa, this isn't really working. So we need to make a change. So same thing for us. We're kind of looking at the demand and that's controlling the supply for me. And then if we have to adjust our numbers, we do. What about, somebody asked about larger packages of properties, like providing acquisition funding, or are you just doing single family? Like if I have a 10 deal package?
I mean, we do those. We do those occasionally, and not because, we're not trying to get them. It's just that most of our operators don't come across large packs of loans, right? So we treat anything that's greater than 4 properties in a pack a bit differently. So we definitely have to have the properties appraised prior to versus so it's a pre-close appraisal versus a post-close appraisal. Have to understand the exit strategy. So if somebody's buying 9 properties to refinance into a rental, we're going to need to see proof that they can do that. Right. And so prior to it, it's, have you done it before? We could probably see through our data sources that, oh, yep, looks like you did this before, like 8 months ago, and you sold it to that local bank. Now we would probably need to have some level of commitment letter from the bank on those properties, within a reasonable time frame that they will be able to offer funds to that borrower. So outside of that, are we doing that? The answer is yes.
Great. Brad asked, it seemed more for me. I'm from Canada and want to invest in the US, how to start. Brad, my recommendation to you is to go in that free group that we have, that Facebook group. So 7-figure house flipping and wholesaling, and ask that question in there. We got quite a few Canadian real estate investors in our mastermind group. That would be, I'll tag them in there. They'd be great people to help you out depending on where you are in Canada. We have quite a few folks from Canada that come to our event at Flip Hacking Live every year. They're really big players in the marketplace there. And we have some that invest from Canada down here in the US. So they have a better answer for it than I do. Let's see. Matt asked, I hate to ask this, but you guys don't do business in Louisiana. Can you recommend a company or two or a reputable site to search for companies that lend similar to yours in Louisiana? So I know we kind of went through that on the podcast that we did. You were very open with, hey, reach out to me. I might have somebody who I might be able to recommend for you, or I might be able to give you some advice or something like that. So this is probably a question that a lot of people have is, you lend in half the country. What about, like, what do we do in these other areas? I got one from Utah. I've got some other people from all around that are asking about these states. And so I'm going to ask that question for all of the people that are on here that you don't lend in, is like, what do you recommend? Like maybe how to find a reputable lender, how to find somebody that we should be working with, or like kind of what to look for.
Yeah, some states unfortunately are easier than others, and I would obviously, a lot of this is sort of pre-pandemic. I'm very comfortable telling somebody to go to Lima One or Civic or RCN, because they're approved there, right? And they're good operators and they're good companies, et cetera. I could not tell you one company that is in Louisiana. I mean, that's way too specific. There's others that are kind of getting into like Mississippi and Alabama along the south. I honestly think Alabama is one of the states of the 8. I'd have to check. I know there was an A state, but because from a business standpoint, so I'd have to. I have a private money person that I'm fairly familiar with, but I'd have to check the data that he gave me as it relates to the MSAs that he's higher on, because I don't remember it possessing a Louisiana MSA.
Yeah, my biggest response to that is like, go out, network, reach out to some people, underwrite them, get some referrals, figure out how they do, if they're good operators. The other thing is network inside of your area. Like, talk to the other people. Who are they using? Maybe there's a small local bank that lends fix and flip. Maybe there's, I've done some great deals with regional banks and smaller banks. They keep the loans in house and they have an appetite for that, and may have changed recently. Right. But then just learn how to raise your own money too. So there's, that stuff's gold. If you can raise money on, fixed interest levels, adjust your payment terms, you can kind of name that stuff. So for Matt, I would recommend, do that kind of stuff. See who the heavy operators are. You can pull that data, like look at all the transactions that have happened and see who the mortgage holders are on properties when you pull that data. So that's what I do a lot of. I really kind of look and deep dive into the data to see, like, who is the mortgage holders, and if I see somebody's name come up over and over and over again, they're probably a local hard money lender. So I can reach out to them. And that's my recommendation for you, especially if Ray doesn't know an institution in Louisiana, then you're going to have to figure that out for sure.
Yeah. I just did a little bit of research. I know Lima One may have stopped lending temporarily, but they actually have a presence in Louisiana. So.
Okay. There you go. If you guys have any more questions, drop them in. And we're pretty much wrapping up here on time. So if there's some last minute questions or some things that you guys want me to ask Ray, I will. As far as I've gotten to almost all the questions. Like I said, if I haven't answered you, it's probably because we already answered them. Someone else asked, if somebody is trying to transition from a day job to a full-time flipper, how would you look at any income situation? So do you guys even look at income?
We don't. It's FICO and equity of property, and then if they're at or above 5 flips, it's flips. So
yeah. So and this is Matt as well in Louisiana. So Matt, like the regional bank and the local banks, they're going to look at income for sure. Yep. They're gonna. I've done a couple of those deals. They are going to close in somewhere around 20 to 30 days. 20 days if they're really good. 30 days if they're okay. And then they're basically asking me for my personal financial statement, my W-2s, my 1099s, basically everything. They're pulling my credit, all that stuff. So it definitely is. It's the full glove treatment on a loan, which drives me nuts. So I'll pay a little bit more for the less hassle usually. So, but see what you can do. See who you can find. All right. Anything that we didn't cover, Ray?
I think the biggest thing that I want to leave everybody with is, how can I have the confidence that, specifically LendingHome, if I write an offer, that you're gonna fulfill the commitment, right? With so many lenders that probably, I called my buddy at such and such and they were at this lender. And then 2 days later, after he told me, no problem, we're going to be here, then the garage door's down. And so I can confidently tell you, because of how we're structured, right, from a securitization standpoint, I know the runway we have. I know the inflow of new business, the kind of the outflow of payoffs or the inflow of payoffs, et cetera, that we have the capital infrastructure, the securitization infrastructure, the technology infrastructure, and the personnel infrastructure to deliver on the commitment. When you go out, the terms I just covered in the meeting today, we will be able to deliver on. That's the biggest thing that I can communicate to somebody, is just the confidence level that we will be here to help you through this period. And then when we come out on the back side of this thing, whenever that will be, it will be even better. But first we have to make it through this period of time, and we want to be able to be that resource to you. It's more painful because of more down payment, yes. But at least from a process flow standpoint, getting from point A to B, we hope that we can be one of those resources for this group. We know we can.
Yeah, and I'm glad you went there, because there's a lot of misinformation out there of like, this lender's shutting down, this lender is not going to be around in 2 weeks. There's they're not capitalized at all. It seems like there's a lot of stone throwing that's going on in the lending space right now for some reason. I'm not exactly sure why, and maybe they're just trying to take market share from each other. And I'm glad that didn't happen on this call. Like you're not even mentioning the companies that have closed their doors, that have stopped, that have put a pause, brakes, stuff like that. So, I mean, I think that goes to show, like, Ray, obviously the relationship that we have, I really appreciate it. Everything that you've done for our members and myself over the past few years, has always been a stand-up guy, always been do things with really high integrity. And that means a lot to me, because even on the podcast that we did, setting up for Flip Hacking Live and talking about your company, you were naming all the other companies that do a great job. And so it's never like, let me throw this person under the bus to make ourselves look better. And that's really the way that I try to do things as well. So, there's a couple more questions. So let me ask one of them, and I think I can answer it real quick. It's about the appraisal. So you do a pre-closing like desktop run, and then they close. He says that if the post-closing appraisal changes, how does that affect my loan? So I think it's important to touch on that, because some other people might have that question too.
Yeah, the answer is it doesn't. So if an operator's at 5+ flips, we're going to do essentially an internal valuation. You're going to know that within a couple of days, that's the value we fund on. After the loan closes, we do the property inspection. We get the valuation report. That's a requirement of our warehouse bank. So let's say that the value came in, we thought $300,000, and then the BPO or the appraisal comes in at $280. I'm making up a number. So we will, from an internal standpoint, try to reconcile that directly with the appraisal management company, but it absolutely has zero effect on that loan or any future loan that person would send in. Meaning, we're not going to say, whoa, need to hold back your rehab funds till we sort this thing out. You'll probably never even know that valuation report came in low.
Yeah, I'll give you a couple examples. We had a house that was out in a little bit more rural space that we were going through the loan process with you guys. The appraisal the desktop came back a little bit low. We showed a couple comps, had a conversation, and then it was changed. Like it was like nothing happened, and we got it done. We managed the rehab, sold the house, made $35,000, paid off the loan, and we were done. It's already paid off, no problem.
The access to the data we have might not be as fresh as somebody super local in the market. And so that was a good example of where if we can get better information that we didn't have and we can see that it's verified, of course we're going to use that. What we can't use is somebody's going, I got a listing that's a mile away and that's exactly what my house is going to look like. It's like, well, we don't use listings. We use closed comparables.
Yeah. And I think like I said, the more prepared that you are, the more information that you have. We had the documentation. We could show that it worked out and no problem. And maybe the appraisal did come back afterwards, but we never heard about it. So just like you said, I have no idea, everything worked out fine. We were in good shape and we've already paid off the loan. So, Yeah, there's been a lot of there's a couple other questions, but we answered them all already. So go back, like I said, go back and listen to it. We've got it in our Facebook group. We'll also have a link to where you can watch the recording and things like that, and we'll put it out in different areas that we have. So Ray, how can people get a hold of you if do you want to give out your information? I know we have a lot of people on the call. So
yeah, I mean, the email's Ray at LendingHome, RAY, and then at LendingHome.com. I always will, if you're already working with somebody, please direct your phone calls to them.
All right. Well, Ray, thank you so much. Is there anything else, any last minute things that you want to share before we kind of...
The people that are on the East Coast, it's 9:47. And so if they're still hanging in doing that, then I just appreciate the investment of time, and I hope I made it worth their time.
Yeah, absolutely. I mean, I usually keep them until like 10 or 10:30 or something like that. So no, we're not going to repeat the number, but we will. You guys can go back and listen to it. Okay. So, and I'll make sure that we don't beep it out on the recording and everything like that.
No worries.
I just got 15 people say, can you give me your phone number again? So, well, Ray, thank you so much. And I appreciate you being kind of open and honest and just seeing behind the curtain and understanding like why you guys do things and how it works. A lot of times it takes the sting off of us because we're doing the same thing. We're seeing the same thing in our business right now. We're having to make changes. We're having to make adjustments. And like when you can see it through the eyes of somebody else, it kind of makes sense. Right. And so obviously when these loans are kind of packaged and resold or purchased, and that buyer is gone, then you really have to start, and you guys are projecting the future. It makes total sense. So, okay. Thanks so much, guys, for hanging out with us. I know all of you are busy. Things are going on. The one thing that I do want to leave you guys with is right now there's a lot of like kind of talking heads. There's a lot of people going out there and using the uncertainty and things like that for their benefit. So really just kind of be careful of who you listen to, who you follow, those kind of things. Like really don't spend so much time on, I realize like I'm on a webinar telling you not to spend a bunch of time on webinars, but really kind of pick and choose where you're spending your time and what's going in. Like make sure you put the good stuff in, make sure that you're turning off the noise a lot of times. And what's happening, I feel like a lot of us are feeling this anxiety, this uncertainty right now. And what we're doing is we're filling it up with more anxiety and more uncertainty from lots of different information from lots of different areas, especially the news, which I think is a total, it will hurt you. It will, your anxiety level and the amount of news that you intake is directly correlated. So don't forget to work on your business and really focus on, this is the time to focus on your skills, to build up your knowledge, to look at the data, to diagnose what's going on, think about the future. I just spent the last 2 days, Tuesday and Wednesday, with my EOS coach for a whole day on Tuesday, a whole day on Wednesday in both of my companies. Tuesday was 7-figure flipping this company. Wednesday was Blackjack Real Estate. And that was a time where I had a choice. I could decide to invest that money and do it virtually like we did, or I could say, I'm not paying that kind of money to have my coach come in and spend the day. And it's probably the best 2 days that I could have possibly spent for me and my team. Huge investment financially, more over those 2 days, we paid over $15,000 in 2 days. So if you guys can think about that, like this is the time where I should be conserving cash, but instead what I'm doing is I'm really investing in ourselves, our business, our time, those kind of things. And that we are preparing for the next 90 days and thinking about lots of different contingency plans. There's nothing better to do right now than to work on the business. And don't forget that, like, don't forget to, my foot is on the gas. I'm just trying to figure out where to drive the car. So that's my recommendation for all you guys out there. If you're still on this call, I appreciate you. I appreciate you spending time with us and obviously following me and everything that we're doing. And Ray, thank you. And LendingHome, the relationship has been great. And if there's anything I can do for you guys, obviously, I will. So,
I appreciate it. Thanks for having me.
Thank you very much.
You've been listening to the 7-Figure Flipping Podcast. If you've enjoyed the show, go to Apple Podcasts to subscribe, rate, and leave us a review. If you're ready to learn the house flipping and wholesaling strategies that are working right now in today's market, check out 7figureflipping.com.